Hi folks, and welcome back to Meaningful Money. Okay, I'm still here at Lamona Cove. It'll be the last one from here, but you find a nice quiet spot and a bit of sunshine and it's worth making the most of it. We're now moving on to the individual taxes as suffered by trusts and trustees, and dealing today with income tax. Now, you remember I said last time there is a special rate of income tax applicable to trusts, the RAT, and that is 50% on interest and on property, and it is 42.5% payable on dividend income. So there is also, you remember, the standard rate band. So the first £1,000 of income received by a trust is taxed at the usual rate, the individual rate if you like. So that's 20% on savings and rental income and 10% on dividends. But only the first £1,000. Thereafter it's at the full whack. And remember that little wrinkle that I said, that the £1,000 band, if one settler, one person setting up a trust, actually sets up several trusts, then that £1,000 band is divided by all the trusts that he's set up. So if you've set up 5, then each trust will only get £200 in that standard rate band. So that's something just worth remembering. So how income tax is dealt with depends on the kind of trust. So I'm going to deal with the most technical one first, which is discretionary trusts. Now, this is how it works. Let's say a discretionary trust receives some interest from some money held in the bank. Well, that interest would be paid net of 20% tax, so they would keep 20% tax back. But given that the rate is 50%, the trustees would have a further 30% to pay. Tell you what, let's put an example up. Just shift down here a minute. I've got a bit more space here. So, oh, 2 lovely dogs. So let's say the income received by the trust is £1,000. Let's make it easy. Well, it would actually receive £800 because 20% is held back, it's taxed at source. So the trustees would get £800, but they would have a further £300 to pay, a further 30%. So they would have to pay that via a tax return, just like you and I would, and the net income received after all that tax has been taken off is £500. So 50% overall. Now, in the case of dividends, the trustees would receive a dividend with 10% already taken off, and they would have a further 32.5% tax to pay, making a total of 42.5%. So that's quite a lot of tax. Now, the point to remember is that if that income is accumulated, that it means it's kept within the trust, then those rates of tax apply. But if the income is paid out to the beneficiaries of the trust, then something different happens. Let me just shove up here again. Something different happens. So let's say, if a trust receives some interest, let's say it's that £1,000 example I've just used, well, they've paid 50% tax on it. And so what's left is £500. If they decide to pay that £500 out to a beneficiary, and that beneficiary is a basic rate taxpayer himself, so just a 20% taxpayer, well, he's effectively paid too much tax. So he can reclaim the difference between his tax rate and the trustee's tax rate. The difference is 30%. So he gets the sort of trust tax bit back, and it's as if he had received the interest himself. So that's all right with interest income and rental income. But when it comes to dividend income, it's more complex, I'm afraid, because if the trustees choose to pay out dividend income to a beneficiary, it's deemed no longer to be dividend income, but rather income from a trust. Don't ask me why these rules come up. We have the biggest, I think, tax code in this country, of any country in the world, in terms of the number of pages. It's just intense. And no idea why they came up with this rule, but if you pay dividend income out to a beneficiary, it's no longer dividend income. Now, I could bore you with the figures, but the long and short of it is this. If you pay out both interest and dividend to a beneficiary, they will always be worse off if you're paying them out dividend income. And they're worse off by about 20%. Well, exactly 20%, not about. So of our notional £1,000 that's received, well, if it's interest, then a basic rate tax paying beneficiary will keep £800 of that £1,000. But if it's dividend income, then the beneficiary would only keep £640. So they've effectively paid 36% tax. I've no idea why that's the case, but that's the rules. So if you're a trustee, just bear in mind, when you're paying income out to a beneficiary, depends on the source of that income, can mean the tax is different on the beneficiary themselves. That's discretionary trust, okay, that's the most complex bit. So let's look very quickly at interest in possession trusts. Now, the trustees are charged at the normal rate now, so you can now forget the rate applicable to trusts. So this is an interest in possession trust, remember. So this has got a life tenant, somebody who has the right to the income on the trust money while they are alive. Remember, that keyword is income. So the trustees in this case, they just pay the ordinary rate. So they will pay 20% tax on any interest. They will pay 10% tax on any dividends received into the trust. And when they pay that out to the life tenant will pay any extra tax that they have to pay if they're a high rate taxpayer or whatever. But as far as the trustees are concerned, it's dead straightforward. So that's interest in possession trusts. And the final one to note is bear trusts. Now, bear trusts, you remember, are effectively straight through trusts, usually used for minor children and things like that. So because they're straight through, the trust is really just looking after the money while the beneficiary either becomes an adult, or sometimes if there's a disabled beneficiary, it'll be looked after until the disabled beneficiary dies. Because it's straight through, the trust is effectively ignored for income tax. So it's as if the income was being received directly by the beneficiary. So depending on what their tax-paying status is, that's the amount of tax they'll pay. Pretty straightforward. The only exception to that is if the bear trust was set up by a parent for a child beneficiary, and if the income received by the trust is more than £100 a year, well, I'm afraid that income is taxed on the parent, on the settler, rather than the beneficiary. Just a weird wrinkle in the law there. So that's income tax for trusts. I realise this is pretty technical and pretty dry, but please leave any questions underneath. I'll do my very best to answer them. But I think for the last time now, I'll move on. But for the last time, from Lamona Cove, thanks for watching, and I'll see you next time.